Hi, I'm Hans Lysglimt. Today is June 21st, 2008, and these are some market comments on what's happening right now. Let's look at the big picture. Let's look at interest rates, and let's look at inflation. I want you to imagine money in the world as an ocean of money, and there being ebbs and flows and streams in this ocean of money. Money supply going up and going down, and different funds, pools of money going in streams left and right, up and down within this huge ocean of money. Because this picture is not too far from the truth. You see, the central bank can provide as much money as it likes. It has the ability to print new fiat money out of thin air if it likes. And this is how the central banks of the world try to regulate what's happening. Now, the central banks want to have stability and full employment. They want the engine of the world to run at full speed at all time. And what they do to keep that, and remember, this is a political goal that the politicians have given to the central banks. And the reason why the politicians want that is that they want stability for their own power play, and they want stability for their own positions. They want people to stay at work and be fully employed so they don't riot against them. So this is all a huge power play. And the central bank will keep the engines going at any price, at any cost, even when, let's say, if there is a war or some disruptive external event, like a huge meteor or something that would really demand that the economy should make a shift somehow. The central banks will still work to keep stability at any price, and they've been good at it, but things are coming to an end. So the central bank will print money or withdraw money, and the central bank will rise and lower interest rates to keep the economy going. And what's happened during the last 18 years is that the economy has been going exceptionally well all over the world. And especially because so many people have entered into the economy from Asia. Prices have been going down. And these people have saved a lot of money. Themselves and their governments have saved a lot of money. So they've saved these dollars that they've kept in their bank accounts and in mattresses and all over the place. So the central bank, especially in the US, have been able to print an enormous amount of money without there being a lot of inflation. In fact, inflation has been low, and therefore interest rates have been very, very low and sinking for a very long time. But this has now come to an end. This is what's so important right now. We have a paradigm shift. We have a major shift in how the economy works and how things look and how the future will be. Because there's many things happening right now, but the fact that the money supply has increased so much has driven asset prices up to exuberant levels where they could no longer go further up. So there's been a crash, and that's what's happening right now. We have a crash in asset prices, in housing, and now the stock market, and there's a new bubble in commodities. And this is due to all the new money that's been printed. And it's important to realize that this money is not evenly distributed, and it's not over the economy, not over the world, not over people, and not over time. So the money pops up different places. It's popped up in the stock market, it's popped up in the real estate market, it's popped up now in commodities, it's popped up in China and developing economies. So there's a huge pool of money out there that can flow either direction, and no one can really control this. So the government has, and the central bank has, a big problem with all the money that's been issued because they don't control where it's going and what's happening with it. So this is, if you look at it from a global perspective, it's almost like a perfect storm that has now come to an end. I mean, the last 18 years have been amazing. The stock market's gone up. Real estate's gone up. People have felt rich. It's been amazing. It's been rock and roll times. It's been the best times ever. But it had to come to an end, and the end is now. So what's going to happen forward is that this huge pool of money, it's going to be hard to manage. The Fed will try to manage it. But on top of that, it has to manage the internal economy in the US. And these are very different questions and very different challenges that the Fed has to manage. And it will be very hard for the Fed to do it right and to accomplish what they want to accomplish. What is going to happen in a bit of a more long-term perspective is that the savings all over the world is going to decrease because the Chinese want to use more of their money. And what will happen then is that the supply of savings will go down and the interest rates therefore has to go up. And inflation is going to go up. And therefore interest rates are going to go up. And therefore when interest rates go up, capitalization rates, the value of things, the value of capital is going to go down. All these things are very much related. And this will take a number of years to play out. So while the interest rates now are at 4, 5%, the long-term interest rates, they are going to go up to 7, 8, 9, 10%. And if you double the interest rate, you can cut the value of a capital asset in half. Now, the markets, they discount this into the future, so it won't necessarily be half. But on the other side, because of exuberant expectations, it might actually be more than half because people have assumed that values would just increase and increase and increase. So it's important to realize that the downturn that's coming now is somehow in proportion to the boom that we've just had. And capital will need to be reallocated in order for things to come back to where they should be. So we have this economy that needs to be corrected. But we have a Fed that doesn't want it to be corrected. It wants the economy to steam on at full speed. So it will do whatever it can to keep the economy going. And what's happened now during this winter, it started in November, December, is that this correction started. And what really should happen is that capital values should go down and capital should be reallocated in a massive way. But the Fed doesn't want that to happen, so it cuts interest rates dramatically. And all of a sudden it seems like everything is in order and there's no problem and the economy started booming again. But I think that ended yesterday on Friday when the Dow fell more than 2%. Now we're back to where we were a few months ago, where the huge correction is on its way. And there's not that much more the Fed can do. The Fed is going to have a new meeting next week. And I believe they will either keep interest rates flat or maybe up it by a quarter point. Because they have to stem this inflation and keep the value of the dollar up. So the Fed is in a terribly complicated situation, and it's very easy for the Fed to go wrong here and make some unwise decisions. And the economy is very much unstable, and small changes could have dramatic effects, especially on the stock market. So my advice, and I've been advising this since November last year, is to sell all capital assets and stay in cash. Because if this perfect storm really turns out the way I believe it will, capital assets will fall dramatically and we will go into a dramatic recession that will last a few years. And there will be a fire sale of assets where you can come in and buy assets on the cheap again. And that's what you want to prepare for. I'm Hans Lysklimt.